Rising mortgage rates can introduce a host of issues into the red-hot housing market, but our next guest argues that there is a slim silver lining in this rate environment. It could help cool off an overheated market. Let's bring in Andy Walden, the director of market research for Black Knight. And Andy, good luck with this one. It's like you're going to try and sell people on broken glass. Explain to me why higher mortgage rates are actually a good thing.
That's right. And it sounds counterintuitive, but for all of the reasons that Diana just mentioned, the housing market is extremely hot right now. We've been coming off an environment where 750,000 homeowners chose not to sell their home last year because of the pandemic, which has caused a drastic fall in the number of homes for sale out there. We're down 40 to 50% from where we were at the same time last year. At the same time, we've been having these record low mortgage rates, and so it's created this environment where it's extremely difficult for homeowners to buy a home, and it's caused these very drastic rises in home prices. As Diana mentioned, and according to some of our collateral analytics numbers, home prices have been up. The median sale price has been up 15% year over year in each of the last 3 months. So introducing this higher interest rate environment, while it does impact homeowners in the amount that they would pay for their home, does reduce some of that bidding war risk and could cool down the housing market, at least to some degree.
I'm still trying to get my head around it. It's good news. Fewer people are going to want your home. Look, what it does is it eats into the price that either you're going to get as the seller, or it increases the price that you're going to have to pay as the buyer, and that's not that's not good news. It means more of that money is not going to the people actually involved in the transaction directly.
Well, when you look at what's going on out there in the housing market right now, you have a lot of homeowners or potential home buyers that simply can't buy a home that want to right now because of some of the bidding war activity. And what you like to see when interest rates are low is homeowners putting that money back in their pocket. That's not what tends to happen. What you tend to do is pay more money for the exact same home. So when you look at the long-term health of the housing market, I think reducing the rate at which home prices are going up, right, that 15% home price growth simply is not sustainable. So pulling that down to a more normal level, reducing the bidding war activity, even though you're maybe increasing your monthly payment a little bit, you're reducing the number of bids that you're competing against in the market, which could be a benefit to you.
You're still not selling me on the broken glass theory, but explain to me, what is the rule of thumb for every, let's say, quarter percentage point that mortgage rates go up? What does that do in terms of the prices people are willing to pay on the house?
Sure. When interest rates move by 1% in either direction, it impacts your buying power by about 12%, right? So as interest rates, and if we look over the last 2 years, interest rates are down about 2 percentage points. So your buying power is up almost 25% from where it was 2 years ago. The roughly quarter of a point movement that we've seen so far here this year is equivalent to roughly a 3% reduction in your buying power. So not a massive move from what we've seen in interest rates so far, but again, a slight cooling effect on the buying power that homeowners have out there in the market right now.
Andy, thank you. You're a good sport. It's good to see you.
Absolutely. Thanks.
Shepard Smith here. Thanks for watching CNBC on YouTube.